Hello everyone, we are from National University of Mongolia, are here to present our analysis and recommendation on APU, the largest alcohol beverage manufacturer in Mongolia, also produce dairy products and soft drinks. In 2017, APU announced a merger transaction including Heineken Asia Pacific subsidiary. With the deal, APU became the largest listed company in the country. We issue a buy recommendation on APU with a target price of 712 Mongolian Tugruks with a potential of 18% upside. Our recommendation is based on three main points. First, APU's dominance in the domestic market. Second, its international growth potential. And last, a strong financial position. So let's start with our first point. The competition in Mongolia alcohol industry is very low due to APU's leading market share. Imagine that almost 8 out of every 10 vodkas and 9 out of every 10 beers on the market are APU's products. This shows market dominance. So, what does this mean to you as an investor? Its pass-on pricing power provides higher revenue. On the other hand, an efficient number of products makes for lower cost. As a result, APU's gross profit margin is expected to grow by 7% over our forecast period. APU's integrated value chain is a sustainable competitive advantage, allowing APU to capture 86% of the domestic market. Supplier, producer, and distributor. One company is at all three positions of the value chain. It creates reduced transaction costs and high-quality products. Moving on. APU has the largest distribution network throughout the country. It has a long-standing relationship with over 8,000 retailers, which includes not only stores, but also restaurants, bars, and so on. APU has a well-diversified portfolio of over 300 products. We are confident that the strong relationship with customers and its differentiated product portfolios are strengthening the local dominance of APU.
As previously mentioned, APU has dominated in domestic alcohol beverage market. However, Mongolian alcohol beverage consumption is higher than the world average and unlikely to provide significant growth beyond the increase in the population. On the other hand, the dairy and soft drink markets are expected to grow by 7% for the following 5 years. APU offsets the slow growth potential in domestic alcohol beverage market by exporting. Located between China and Russia, Mongolia has unique geographic advantage, enabling APU to export with lower transportation costs. Besides, APU can exceed its domestic sales by multiple times with the very little penetration into the Chinese and Russian market. But there is a question: why should foreign consumers buy APU's products? According to international research, both in Russia and China, the premium alcohol beverage consumption is increasing due to consumers' tendency to use more luxury product and increasing disposable income. And on the other hand, the premiumization is APU's main strategy for products. Thus, we believe that APU has potential to export successfully. But every company faces inexperience with new markets. So how APU will compete with foreign players? APU has contracted with Tatspirtprom to distribute and sell its ultra-premium brand through its Russian biggest distribution channel. Additionally, APU exports to Russian market through our 200 retailing spots. And we believe that Heineken's marketing expertise will support APU's exports as in China. To conclude, the geographical advantage, premium products, and also supporting cooperations will assist APU's international growth prospect.
Turning to our last point, APU's strong financial position will provide long-term profitability. Let's take a look at revenue projection. We see 5 growth drivers, with steady demand for alcohol beverage market and robust increase in dairy and soft drink markets. Its high market share as well as export expansion. APU's volume sales will increase by 5% CAGR annually. Last year, APU's total revenue growth was 85%, but it was related to merger effect. APU's domestic sales and high export sales will drive overall growth of 12% CAGR. As you can see, APU's net profit margin is to be approximately 18%, which is higher than domestic and regional peers because of the following three reasons: economics of scale and the precious energies, international sales growth, and no interest costs. APU has no debt in its capital structure, and we assume that company will not use debt instrument going forward because APU has a strong cash flow generation and operating cash flow is expected to increase by 11% CAGR. On the other hand, the company's operating cash flow margin is considerably higher than domestic and regional peer companies. As for CapEx, the company's total manufacturing capacity is around 65%. Therefore, CapEx ratio is expected to stay stable. Finally, APU's return on equity is expected to reach 23% in 2024 due to lower CapEx and high profit.
Next, we'll be discussing our valuation. With dominance in domestic market, international growth potential, and a strong financial position, our valuation arrives at 712 Mongolian Turks, presenting 18% upside. To value APU, we used weighted average of discounted cash flow model accounting for 70% and comparable valuation remaining 30%. For DCF, we used free cash flow to equity model with two stages of growth. For discount rate, we calculated 21% of cost of equity based on 14% of risk-free rate, driving capital asset pricing model. Also, we assumed 3.4% internal growth supported by East Asian and East European long-run economic growth. This approach sets the target price of 664 Mongolian Turks. For comparable valuation, we selected 5 peer companies within each APU's business segments and derive comparable value through sum of the parts analysis. As mentioned previously, the company operates in 4 different business segments: beer, dairy, and soft drink. Also, EV to EBITDA multiple is chosen because of the company's intense capital requirement for operation. This approach sets the target price of 825 Mongolian Turks. For sensitivity analysis, cost of equity is more sensitive than terminal growth in our DCF model. For forecasting assumptions, the company's performance in vodka segment is most sensitive to our target price. Moreover, a Monte-Carlo simulation with 100,000 trials conducted with following variables supported our buy recommendation with 68%.
To complete our analysis, we identified potential risks. We will focus on the following 3. First, raw material price. APU's raw material cost composes around 85% of the cost of goods sold. And according to the World Bank commodity market forecast, the main raw material prices are expected to stay stable. Besides, APU is taking advantage of Heineken's international supply chain for beer production. So we believe that APU will mitigate this risk by its pass-through pricing mechanism. Second, currency fluctuation. APU purchases around 60% of the cost of goods sold using USD foreign currency. And USD to MNT exchange rate has been increasing year by year. We see that APU can mitigate this risk by its export revenue provide USD denominated receipts. And last, excise tax on alcohol. In 2018, APU's excise tax expense accounted for 25% of the total revenue. We see that APU can mitigate this risk by its cost-plus model and utilize their dominance in the domestic market. APU has 3 main institutional shareholders and a free float of 5.6%. And also,
1 minute
2 of
remaining.
the institutional shareholders are from international, including Heineken Asia Pacific. It shows company's corporate governance stability.
Finally, let's recap our main reasons for our buy recommendation. 1. Dominance in local market to give a steady domestic gain. 2. Its international potential to provide APU with long-term growth. And 3. A strong financial position to deliver long-run profitability. With these 3 points, we are issuing a buy recommendation with a target price of 712 Mongolian Turks with the potential of 18% upside. Thank you for your attention. Our team will now answer your questions.
Great, thanks.
I guess if I'm to comparing your two primary valuation measures, the peer group valuation ends up with a much higher number. And I just wonder, the risk-free rate in Mongolia is obviously much higher than in a number of other markets. Do you think that's a key reason why the DCF would be a much lower valuation? And would that make it a more appropriate valuation metric for the company?
Okay, yes, you're right, and our comparable value is much higher than our intrinsic value. So, and in our country, there is lack of direct comparable company. So we weighted much lower weight, which is 30% on our multiple valuation.
And also related to the export expansion of the APU company, we just choose the other regions, Asia Pacific regions, long-term growth.
Can I ask a question about the Heineken Asia Pacific acquisition? Since it must have been a bigger acquisition for the firm, and can you maybe tell us when it happened? How did they finance it? Would there be a winner's curse that could happen because of the recent developments across the world? Would you be still confident that this was the right acquisition to do for the firm?
As for the acquisition, there was before the acquisition, APU was the largest alcohol beverage manufacturer in the country, and they just merged with the second biggest manufacturer of alcohol. And with this merger, Heineken Asia Pacific just participated in the merger. And also, that was the largest merger of our country's financial history.
Mm-hmm. And the purpose of the merger was for APU. APU's goal of merger was to expand their sales in international market. And after the merger, APU's international sales growth was very high. And last year, in 2019, the company's export sales growth was 190%. And company sees that in 2020, the company's export sales growth will be 300%, and we think that this is quite a merger effect.
Additionally, the company financed that transaction to issue new shares privately.
Okay.
What is the current dividend policy of the company? Dividend payout policy?
Okay, let me answer that question. The company has a large debt payment in 2017. When the company has a large debt payment, the company has a dividend policy that the dividend payout ratio can't be more than 20% of the net profit. And after the merger, company paid all of the debts, and the company's dividend per share increased. And in 2018, the company's payout ratio was dividend payout ratio was almost 100%, which means they paid all of their net profit to their shareholders. And in 2019, the company's dividend almost doubled, which is 71 Mongolian tourists. It's a 12% return. The company's dividend policy is consistent.
Okay, you mentioned about the international potential. Can you actually tell us more about what's the approach and how they are going to achieve that?
Thank you. Nice question. And APU is penetrating to Russia and China, and aiming to penetrate into very little market share. And on the other hand, APU is cooperating with Russian biggest alcohol beverage company. So we see that there is no competition pressure from Russian market. And so we believe that APU will be successful in Russian market. And on the other hand, the Heineken is working in China with 4 brewery companies, and they have much experience and expertise, marketing expertise, and we believe that this expertise will support APU's exports in China.
And also now they already started exporting, like export expansion, and the export expansion is through the long-term relationship like Heineken Asia Pacific. And as for in Russia, there's a Tatspirtprom, which is the largest distribution channel company in Russia. And also in first step, they just started exporting their premium products, as you can see in a slide.
I noticed that when you did your DuPont analysis, you are expecting the asset turnover to improve significantly due to higher utilization. Now, obviously, out of the components of DuPont analysis, asset turnover is very sticky, and it is very difficult to improve. And I'd like to know why you think it'll be improved through higher utilization. What would be your argument there?
After the merger, the company possessed much more plant and equipment. As our calculation, the company's utilization rate will be around 75%, and according to company information, there will be no growth capital expenditure in following 5 or 6 years.
And additionally, the company renewed its equipment about 6 to 7 years ago, so it's new, and the company is expecting no more capex ratio in the following years.
After the merger, APU's property, plant and equipment is increased by 69%.
Just turning back to the international market for a moment, because it's a big part of your growth. How do you think the profitability of the business will be, given the brand name's not as well known and it's not all the vertical integration and their own distribution? Will it be at a lower margin?
Thank you. And about cost in Russia and China, the APU is exporting its premium products, which means that products are very expensive compared to the other products. So we see that the margin will be same. And on the other hand, APU is producing Tatspirtprom's products in Mongolia, and on the other hand, Tatspirtprom is distributing APU's products in China. So we see that there will be no higher cost in China, Russia.
And also geographically, the Mongolia is between the Russia and China, and other advantages, these two markets are kind of big markets in alcohol products, and also that's an advantage for us for some kind of a distribution cost.
I saw in one of the chart that about dividend, and then 2014 there was no dividend. What happened to 2014 with the losses?
In 2014, they had a loss.
Yes.
In revenue.
Yes, I will answer that question. In almost since 2010, the company took the large amount of debt that denominated in USD dollar from EBRD and Credit Suisse to finance the capex for plant and equipment. So USD to Mongolian tenge exchange rate is increased year by year, and it's result of that the company take the loss in 2014.
And the company's and the company's debt payment in 2014 and 16 was much higher because of the debt.
And also currency fluctuation too.
How does the company compensate its management leaders? I mean, is there any stock option program that is going on at the moment?
That is time. Thank you.